Hey everyone, and welcome. It's kind of wild when you stop and think about it, how we pay for things. I mean, the journey from actually handing someone cash to just tapping your phone or clicking a button, it's an incredible story. Today, we're going to dive into that whole evolution of your wallet.
So yeah, that's the big question, right? How in the world did we get from Main Street to everything being on your smartphone? Well, it's a story that really unfolds in three huge steps. First, we moved the store online, then we put a bank in everyone's pocket, and finally, we started to reinvent the very idea of money itself.
All right, so part one. It all kicks off with the online shopping revolution. The big problem to solve was, the real world. Physical stores have business hours, and you actually have to be there to buy something. The internet was about to change all of that.
And you can really see how each decade just built on the last. I mean, it started way back in the 70s and 80s, really just with businesses figuring out how to swap data electronically. Then the 90s happened, the internet went public, and bam, pioneers like Amazon and eBay just turned everything upside down. The 2000s gave us faster internet, which took shopping global and started putting it on our phones. And now, it's a whole other level, with AI predicting what you want and letting you buy stuff right from your Instagram feed.
So here's the thing. E-commerce was amazing, no doubt. It solved the problem of distance. But it created a new problem, right? It chained you to your desk, to your computer. To really be free to shop anytime, anywhere, we had to cut that cord. And that's what sets the stage for the next massive leap.
And this is where the solution really shines. M-commerce, that's mobile commerce. It wasn't just squishing a website onto a tiny screen, no way. It was a complete rethink, built for speed, built for convenience. It was a change in our behavior. Suddenly, that impulse to buy something while you're on the bus or waiting for coffee, it became real. The entire store was now literally in your pocket.
Okay, so shopping is now mobile. Awesome. But this created a brand new, absolutely massive problem. Billions of people all over the world could now see these online stores, but they couldn't buy anything. Why? Because they didn't have a bank account. The answer? Mobile money. And seriously, this was a complete game changer. Think of it as an electronic wallet that lets you send, save, and get money using nothing more than your phone. And here's the most critical part. You do not need a traditional bank account. This wasn't about making banking easier for people who already had it. This was about creating a system for everyone else. Okay, and this is a really important distinction because people get these two mixed up all the time. Mobile banking is just your regular bank's app on your phone. You still need that bank account. But mobile money, like the trailblazing M-Pesa service in Kenya, was built from the ground up for people who were completely outside the banking system. It's a whole different animal. And you really can't overstate the impact of this. It's been absolutely massive. Platforms like M-Pesa in Kenya, Paytm in India, Bcash in Bangladesh, they've brought millions and millions of people into the formal economy. Small businesses in rural villages could suddenly thrive. People, especially women, gained financial independence for the first time. It was truly revolutionary.
All right, so we've got the store in our pocket, we've got a bank in our pocket. What could possibly be next? Well, now we get to the most radical, most ambitious idea of them all. What if we could build a financial system that doesn't need banks at all? And this idea, it goes right back to the very beginning of Bitcoin. This quote from the original white paper by its mysterious creator, Satoshi Nakamoto, just nails it. The vision was for digital money that could move directly from me to you anywhere on Earth, with no bank, no credit card company, no middleman taking a cut. So how on earth does that actually work? Well, the tech behind it is called blockchain. The easiest way to think about it is like a global digital receipt book, one that's copied and shared across thousands of computers, so no single person controls it. When you want to send money, the request goes out to the network. All these computers check in and say, yep, this is legit. Then your transaction gets bundled with others into a block, and that block gets locked onto the chain before it, creating this secure, permanent, and transparent record. And when you put them side by side, the differences are just stark. Traditional money, it's centralized. Governments and banks are in charge. Crypto, it's decentralized, run by the network of users. The records are public for anyone to see, not hidden away. And the supply of money is often fixed by math, not decided by a central bank. It's a fundamental shift in who's in control. And it is so much more than just Bitcoin these days. A whole ecosystem has exploded. You've got Bitcoin, the OG, kind of like a digital version of gold.
Then you have Ethereum, which was revolutionary because it introduced smart contracts, basically code that can automatically enforce agreements. You got others like Ripple, built to help banks move money super fast. And then you have stablecoins, which are designed to be, well, stable. They're pegged to something like the US dollar to avoid all those crazy price swings.
All right, let's bring all this home. We've got e-commerce, we've got mobile money, and we have this wild world of crypto. So what happens when all of these things start to merge together?
I mean, when you start mixing these worlds, the potential upsides are just massive. Online stores could suddenly reach billions of new customers who were previously unbanked. International payments could settle in minutes, not days. Merchants could pay way lower fees than they do for credit cards. And the transparency of blockchain could even help cut down on certain kinds of fraud. It's all about building a more open and efficient global economy.
But let's be real, it's not all smooth sailing. There are some major hurdles we still need to clear. The prices of many cryptocurrencies are incredibly volatile, which is a huge risk. Security is a constant cat-and-mouse game with hackers. Governments everywhere are still trying to figure out the rules. And of course, the environmental impact of some of the older blockchains is a serious problem the industry has to solve. So where is all of this headed? Well, right now, we're seeing these two giant, kind of competing ideas taking shape. On one hand, you have decentralized finance, or DeFi, which wants to rebuild everything from loans to insurance on the blockchain, with no companies in the middle. And on the complete other end of the spectrum, you have governments creating their own digital currencies, CBDCs. Think of a digital dollar or a digital euro. This story is definitely not over yet.
And that really brings us back to you and your wallet. It's already digital, right? It holds your credit cards, your plane tickets, your concert tickets. But after seeing this whole journey, the real question is, what's going to be in that digital wallet 10 years from now? That's a future that's being